So you've probably heard this advice. Just buy good companies. Apple, Microsoft, Coca-Cola. They are not going anywhere. You might have even said that to yourself. And honestly, if I have to hear that one more time, I'm going to go crazy. But honestly, I kind of get it, right? It sounds safe. It sounds logical. But I'm going to show you today why that mindset is potentially one of the most dangerous things that you can do with your money, and why the boring, unglamorous alternative is almost certainly going to make you richer in the long run. Stay with me, because this one I think will change how you think about investing forever, or at least it really, really should. Because the biggest thing I want you to take away from this video is the concept of something called positive expectancy, and how it is just genuinely, literally magic. Now, before we even talk about what to buy, we need to talk about how to actually think about investing, because this is the thing that people skip, and they skip this whole entire section entirely, and it costs people a fortune. So please do not be the person who skips this, okay? Here is the foundation. This is the start of everything. The single biggest driver of your long-term investment success, it's not the individual stocks that you pick. It's not timing the market. It's not even a good fund, picking the right fund. It's not even chasing a star fund manager. It's the asset class that you put your money into. Now, what do I mean by asset classes? Well, okay, think equities, so that's the stock market, bonds, commodities, property. These are broad categories of investment. And look, the research is overwhelmingly clear. Your exposure to the right asset class drives the absolute lion's share of your long-term outcomes. So the very first question you should be asking yourself is not, should I buy Apple? Should I buy Microsoft? The first question is, what is the right asset class for my situation? Look, if you're investing for a long-term goal, so a pension, retirement, a pot of money that you're not going to touch for 20, 30 years, then the asset class of equities is almost certainly going to be the right answers. Equities, of course, have the longest and strongest track record of pretty much any asset class there is out there, to be honest, full stop. Now, maybe you want a bit of stability, a bit of diversification. So perhaps something like a 60-40 split, 60% on equities, 40% on bonds. That's a classic portfolio structure that balances growth with a little bit of kind of cushioning. Or maybe if you're young, you've got decades ahead of you, 100% in equities makes complete sense for your situation. Both are perfectly valid. Now, this has nothing to do with individual stocks, but the point here is get the right asset class first, and everything else flows from that. So let's say that you've decided equities, investing in the stock market is right for you. Great. Now, the next question is, how do you actually get exposure to equities? Here's the thing that most people do completely wrong immediately once they've got to that point. The logical starting point, your absolute default, should be to capture the average of that asset class. Not the best performing stocks, not in the ones that look exciting, but default, the de facto average is a great place to start. Remember, by getting the average, you're doing 50% better than most of the other people. So that's where you should start. And what is the average of equities? Well, it is a global market capitalization weighted index fund. What that means in plain English is this: a fund that holds essentially every publicly traded company in the world, pretty much, weighted by the size that they are. The big companies make up more of the fund, and the smaller ones make up less. It is, by design, the de facto average equity portfolio that you should start with. You just own a tiny slice of the whole market. Now, for the vast majority of people, literally 90% of investors, simply getting into the right asset class through a global equity index fund will give you everything you need from investing. That's it. It's the whole game. Now, I know the problem is it's not very exciting, is it? I know it doesn't make for a great dinner party story about your high dividend passive income stocks or the one winner you picked but failed to mention the other 20 that lost money. But this works constantly, reliably over decades to give you exposure to the asset class equities that will determine your success with investing or not. Now, I mentioned at the start this thing of positive expectancy. Let me now introduce you to the concept that underpins all of the reasons why that is true. Because once you understand it, you will never look at investing the same way again. Or I should hope not. Again, it's called positive expectancy. Here is how I explain it to people. If someone genuinely put a gun to my head and said, will the global stock market be higher in 20 years than it is today? My answer, without hesitation, is yes. Will there be crashes along the way? Absolutely. Will there be years where it drops 20, 30, even 40 or 50%? Sure. But over a long enough time horizon, the global stock market as an asset class goes up. That is positive expectancy. And above all else, you can have faith in it. And the question is, why does it always go up? Because essentially it represents kind of human economic activity. It is the aggregate output of companies around the world producing goods and services, innovating, growing. As long as the global economy continues to function, and it kind of always has, and if it doesn't, this is the least of your worries, equities as an asset class will trend upwards. Even if it's just in line with inflation, it will trend upwards. That positive expectancy is the most powerful thing that you have as an investor. And here is the thing that drives me crazy, and it's the biggest thing that I want you to take from this video. Positive expectancy is the thing that you should guard with your absolute life. This is the critical point. You want to protect positive expectancy because every time you make a decision that moves you away from that global equity index, every time you make a more specific, a more active decision, what you actually are doing there is you're starting to chip away at positive expectancy. Let me show you exactly how that works, okay? Because it's super important. So think of all of this as a pyramid. At the bottom, you have got the global stock market. That has full positive expectancy. One step down, like let's say you sort of take the global index fund and then break it down a little bit, you might break it down by geography. So for example, the S&P 500 in the US or the FTSE 100 in the UK, Japanese stocks, emerging markets, whatever. Now, they're still relatively broad, but what you've done is you've made an active decision to move from the global stock market to specifically one geography. And the reason that you've probably done that is because you believe, key phrase, that one region will outperform the others. Otherwise, why would you do that? That, my friend, is the first point of failure and the first point where you start to chip away at positive expectancy. But you go one step further and you're looking at sectors, for instance. Maybe you like consumer staples sector of the US market, companies that kind of sell everyday essentials. Or the technology sector, or whatever it is. Again, you've made an additional active call, another point of failure, another chipping away of positive expectancy. But yet you go one step further still, and you're picking individual company stocks within those sectors, in those geographies. And that is where things start to get super, super dangerous, okay? Like, you've got to start thinking about this as chipping away at positivity. What I want to do is actually use a really common example. Let's talk about Coca-Cola, because it's the kind of stock that because Warren Buffett is a big advocate of Coca-Cola, right? So everyone thinks like, oh, great, I'll go along with that, because it's the kind of stock that people hold up as like the definition of safe, not going anywhere. It's been around forever, like ever and a day. Everyone drinks Coca-Cola. It's not going anywhere, right? To get to the decision to buy Coca-Cola and get to the point where you're putting your money into that individual stock, think about what you've actually had to do. You've decided that, yes, okay, I want equities. The exposure to equities is the right thing. And then you've said, I believe that the US market will outperform. And you want consumer staples sector. And within the consumer staples sector, you've decided that Coca-Cola, out of all of the companies in that sector, is your pick. That is 4 separate active decisions, 4 separate points of failure, 4 separate points where positive expectancy is chipping away. And for each one of those decisions it's something that you can second guess, change your mind on, panic about during a downturn, and ultimately get in the way of what actually matters. Staying invested in the asset class of equities. Overthinking these decision layers is the single biggest mistake that I see investors do. Not only that, but at the individual stock level, positive expectancy disappears entirely. Here's something that most people genuinely, I think, seemingly don't know. And it should stop you completely in your tracks. The majority of individual stocks that have ever been publicly traded at some point eventually have gone to zero. Completely bust. Delisted, bust, gone. Okay? The majority. Think about the biggest names from 20 or 25 years ago. Some of them you might have even or have heard of. Many of them no longer exist. Blockbuster, Kodak, Lehman Brothers, Enron, WorldCom, the list goes on. I could name you thousands, right? Think about all of the biggest names that were in the stock market 20 years ago. Think about how different the market capitalization index looks today. So here's my challenge to you. Think about Apple today, okay? Because this is a common one that I see all the time. Right now, genuinely, you cannot see a world where Apple doesn't exist. It feels untouchable right now, doesn't it? They've got ridiculous amounts of money in the bank. Everyone's got an iPhone. God, all of my work equipment is Apple. It's not going anywhere, right? It feels untouchable. They're the most valuable company in the world. And yet, and I will try and say this as clearly as I can, I would almost guarantee that Apple, in its current form, will not look the same in 20 to 25 years. Look, that's not being dramatic. It's just history and fact. Companies rise and companies fall. Industries are disrupted. Technology changes. What looks like certainty today rarely is. And this is absolutely why. Just buy and hold good companies. Oh God, that drives me crazy. And they're not going anywhere. Just buy good companies. That is why that logic is so inherently flawed that I cannot even begin to essentially stress how aggravating it makes me feel when people who aren't experienced investors and have all the best intentions in the world think along those lines. It drives me crazy, okay? Because another question that you have to ask yourself is, when you own an individual stock, every single day that you own that stock, you are faced with 3 questions. Should I buy more? Do I hold? Should I sell? Every single day, you should be asking yourself that question within individual stocks. With a global equity index fund, you don't have those questions. You know it has positive expectancy. You know the answer is always the same. Invest new money as soon as you have it. Keep it invested. Stay out of your own way. But with an individual stock, well, think about it, right? Say, for example, you're holding Apple stock today. If it drops by 50%, you don't know whether it's going to bounce back. You don't know whether to hold because it's going to bounce back in due course, or should you sell it because it might drop another 50%. And eventually it might go to zero. That concept of catching a falling knife is very, very real. And that second guessing, should I buy more? Should I sell? Should I hold? All the time. That emotional decision making is where most individual investors lose money. So what does that all mean practically? It means that your investment strategy should be boring as humanly possible, ideally. Here's what it might look like. Step 1, decide on your asset class split based on your goals, time horizon, and risk tolerance. You got a long-term time horizon, more equities. Shorter, maybe bring in some bonds or cash or some other diversifiers. Step 2, get exposure to each asset class through the broadest, most representative fund you can. For equities, that's a global market cap weighted index fund. For bonds, that's something like a global aggregate bond fund. You're buying the average. At least start there and then look to try and improve. And the fact is that average has positive expectancy. Step 3, just invest consistently. Every time you put money in, you know that it has positive expectancy. Don't try and time the market. Don't wait for a crash. Don't wait for a better time. The best time to invest is when you have money to invest. Just get on with it and just do it. Step 4, leave it alone. Seriously, just leave it alone. You know, if you're doing it the right way, it has positive expectancy. So every time it goes down, you should actually be thinking to yourself, brilliant, I've got an opportunity to buy more at a cheaper price. The biggest enemy of long-term returns isn't market crashes. It's you. It's tinkering, it's second-guessing, it's selling in a panic or convincing yourself that you found a better stock or a better option or a better gamble. That's it. That's the whole strategy. Boring, right? Super, super boring. Now, I really hope that you've picked up from this video that the concept of your asset split, i.e. the amount of money that you have in stocks, bonds, attack and defense, is the single biggest driver of returns and investment success. This is something that I go into way more detail about in this video here. So give it a watch, because what I'm going to show you might just be the most important aspect of investing. And I almost guarantee that you aren't doing it correctly at the moment. So give it a click and I will see you there.